McDonald's is one of the largest restaurant chains in the world. Every single day, millions of people pass through its doors, order burgers, fries, and sodas, and leave without ever questioning how this company actually makes money. But here's the truth that most people never realize. Almost none of McDonald's real profits come from selling food. In fact, if McDonald's stopped selling burgers tomorrow, the company would still be one of the most powerful businesses on earth. Why? Because McDonald's is not really a fast food company. It's a real estate empire in disguise. Most people assume McDonald's makes money the same way other restaurants do. They imagine cheap ingredients, massive volume, and thin margins. They think the money comes from selling millions of meals every day across thousands of locations worldwide. And yes, McDonald's does sell a lot of food. Mountains of it. Billions of transactions annually. But food sales are not what makes the company powerful. In fact, the restaurant side of the business is surprisingly fragile. Labor costs are rising year after year. Supply chains are expensive and vulnerable to disruption. Profit margins on food are razor thin, often just pennies on the dollar. Restaurants fail all the time. Independent restaurants, regional chains, even large franchises collapse under financial pressure. But McDonald's doesn't. McDonald's thrives through economic downturns, recessions, pandemics, and market shifts that destroy its competitors. The question is, why? To understand McDonald's, you have to stop thinking like a customer and start thinking like a landlord. Because that's exactly what McDonald's is. The company doesn't just franchise its brand. It usually owns the land and the buildings where its restaurants operate. Think about that for a moment. When you see a McDonald's on a busy corner, in a shopping district, or near a highway exit, there's a strong chance McDonald's owns that property. The franchisee pays to run the business, manage employees, order supplies, and serve customers. But McDonald's owns the property underneath it all. Prime locations, high-traffic intersections, and commercial hotspots are purchased by McDonald's and leased to franchise owners. The money doesn't just come from food. It comes from rent. Every single month, the franchisee sends rent and royalties straight to McDonald's corporate headquarters. The real money is invisible to the casual observer. It flows beneath the surface, hidden behind golden arches and Happy Meals. Here's how the model works, step by step, and why it's so brilliantly designed. First, McDonald's buys land early, often before an area fully develops. They identify growing neighborhoods, expanding suburbs, and emerging commercial zones. The land is purchased at relatively low prices because the area hasn't reached its full potential yet. Then, the land appreciates over time as the area grows. Schools are built, housing developments expand, more businesses move in. The property McDonald's bought for a modest price 10 or 20 years ago is now worth multiples of the original investment. Next, a franchisee opens a restaurant on McDonald's property. The franchisee invests their own money, hires staff, manages operations, and takes on all the daily headaches of running a restaurant. But here's the key. The franchisee pays rent, royalties, and fees to McDonald's. They pay whether business is booming or struggling, whether margins are tight or comfortable, whether the economy is strong or weak. McDonald's collects money whether the restaurant succeeds or struggles. The risk sits with the franchisee. The leverage sits with McDonald's. This is not a traditional restaurant business. It's a real estate model cleverly disguised as one. When you look at McDonald's operating income and break down the numbers, a large portion comes from rent and royalties, not from food sales. The rental income is predictable, long-term, and inflation-resistant. As property values rise, so does McDonald's wealth. Franchisees work long hours, manage staff, deal with customer complaints, and navigate supply chain issues. But McDonald's collects reliably every month, regardless of those operational challenges. This is why the company has survived recessions, inflation, changing food trends, and competitive threats. While independent restaurants close and even large chains struggle, McDonald's assets quietly grow in value. The Golden Arches might advertise hamburgers, but the balance sheet tells a different story. The system is designed to generate consistent wealth with minimal risk on the company's part. It's a financial architecture built for stability and compounding returns. The genius of McDonald's model is actually threefold, and each layer reinforces the others. First, control. McDonald's dictates locations, branding standards, menu items, and operational procedures. Franchisees have strict guidelines to follow. This ensures consistency and protects the brand, but it also keeps power centralized. Second, risk transfer. Labor disputes, supply chain issues, equipment failures, and operational challenges are the franchisee's problem. If a restaurant underperforms, the franchisee absorbs the loss. McDonald's still collects rent. Third, compounding assets. Real estate appreciates over decades. While restaurants come and go, while menus change and trends shift, the land remains, and it grows more valuable. McDonald's accumulates valuable property quietly, building an empire that operates on a timeline measured in generations, not quarters. This structure is why McDonald's is untouchable in ways most fast food chains can only dream of. Burger King, Wendy's, and other competitors operate differently. They don't own the same scale of real estate. They don't have the same leverage. They're more vulnerable to market forces because they're actually in the restaurant business. McDonald's is in the real estate business that happens to serve food. Now here's where it gets even more interesting. McDonald's is not unique. This system appears in many industries, often in places you wouldn't immediately suspect. Retail chains that own their storefronts don't just make money from selling products. They own appreciating assets in prime locations. Banks that own branches aren't just processing transactions. They're sitting on valuable urban real estate. Universities that own campuses are sitting on endowments and property portfolios worth billions. The real power does not come from selling products or services. It comes from owning the systems, infrastructure, and platforms that make those products and services possible. Most people compete on effort. They work harder, longer hours, trying to outperform competitors through sheer determination. But institutions compete on structure. They build systems where the leverage is built in, where the risk flows downward, and where the profits accumulate automatically. So why don't people notice this? Why does McDonald's still look like just another fast food chain to most observers? The answer is simple: perspective. Customers only see the counter. They see menu boards, cashiers, and food packaging. Employees see the kitchen, the drive-through window, and the daily grind. Franchisees see operations, staffing challenges, and monthly expenses. The system itself is invisible. It operates at a level most people never examine because they're focused on the transaction right in front of them. By the time someone understands how the system actually works, contracts have been signed, leases have been agreed to, and corporate power has already locked them into a structure that inherently favors McDonald's. It's not a conspiracy. It's not hidden in some secret vault. It's just business designed to work quietly and efficiently, extracting value at scale while maintaining a friendly, accessible public face. The takeaway here is not, go start a restaurant. It's actually simpler and more uncomfortable than that. The most powerful businesses don't chase customers. They don't compete desperately for market share. They don't burn through cash trying to outspend competitors on advertising. Instead, they position themselves above the transaction. They own the infrastructure. They control the platform. They collect value automatically because they've structured the system to work that way. McDonald's doesn't fight for sales. It owns the system where sales happen, and that makes all the difference. Once you see this pattern, you begin to notice similar structures everywhere. In finance, insurance, technology platforms, and even education. Banks don't just lend money. They collect fees, interest, and take collateral. If loans default, they seize assets. The risk is transferred to borrowers while the bank maintains control of the system. Insurance companies don't bear the risks they insure. They transfer risk to policyholders while collecting premiums. They invest those premiums and profit from the float. Universities charge tuition, but they also invest in massive endowments. They own land, buildings, and intellectual property. The tuition pays for operations, but the real wealth accumulates elsewhere. Airlines lease planes and terminals. They shift maintenance costs and risks to contractors while maximizing efficiency and profits through route control and pricing algorithms. The pattern is the same across industries: ownership, leverage, and risk transfer. Understanding this pattern fundamentally changes how you see business. Companies that appear fragile or competitive are often untouchable once you understand their structure. Their public-facing operations might be just a front, a consumer-friendly facade that masks the real business underneath. The real wealth sits behind the scenes, in land, infrastructure, contracts, distribution networks, and financial systems that compound value over time. Most people never notice because they're looking at the wrong layer of the system. They see products, not platforms. Transactions, not infrastructure. Individual businesses, not systemic leverage. And this blindness is by design. The more visible and accessible a business appears, the less likely people are to question what really makes it profitable. McDonald's is just the beginning. Once you understand this one example, similar strategies become visible across industries. They're everywhere, quietly transferring risk downward while collecting value at the top. The franchisee takes the operational risk. The customer sees only the transaction. The employee experiences only the labor. But McDonald's owns the land, collects the rent, and watches its assets appreciate. Next time you see a franchise, a bank branch, or a university campus, don't just look at the product, the service, or the tuition. Don't stop at the surface level. Look at who owns the system underneath it. Look at who controls the infrastructure. Look at where the real leverage lies. Because that's where the real power is. That's where the real money flows. And that's the difference between working in a system and owning one. McDonald's understood this decades ago. And that's why, while competitors rise and fall, the golden arches remain standing. Not because they sell better burgers, but because they own better real estate. The lesson is clear. In business, the most valuable position isn't serving customers. It's owning the ground they stand on.